Appreciate everybody coming out. Like I mentioned, I know some people kind of still straggling through, and they'll get here. We got some time. But if that's okay with you guys, when they get here, I probably will be done, but I'll probably recap it and do some Q&A. That's cool? Okay, so for everyone I know you guys may know me or may not know me. I know you know me, and I know you know me too. So my name is Anthony Lawson. For the people that don't know me on YouTube, my name is Anthony Lawson. I invest in real estate. I've been at it now going on 7 years, and I have a portfolio of 235 units, and it's across 3 states, going on to 8 states now, with some deals in the works. So I'm here to let you guys know what you can do actively versus passively investing. So that's what the topic is: how to invest passively in real estate. And Global Investment Capital Group, that's a entity that I own, and it is a fund, and we can talk about what that is. So full disclaimer, investing involves risk. You have substantial rewards, but past performance does not guarantee or dictate future results. Historical returns, expected returns, profitability, rejections is not reflected to what's going to happen in the future. Anything can change in real estate. So this is just a disclaimer. Speak with your own tax accountant, advisor, whoever you seek legal advice from. So I would fully disclose that. And if you want to look at www.globalinvestmentcapitalgroup.com, that is just the website that will tell you about investing. All right, so table of contents. What we're primarily going to be speaking about is how to invest actively versus passively in real estate, the benefits of passive investing. Pretty sure that a lot of people may know what it is, but if you don't know what it is, passive investing is pretty much where you deploy capital into either syndication, we'll talk about what that is, a fund, we will discuss what that is, or some type of joint venture partnership with an entity or a person that you rely, like, and trust. And you like the deal, of course. How to invest in real estate with your self-directed IRA. So a lot of people don't know that you can do that, but you definitely can. How to invest in real estate with your solo 401k, which that's good for entrepreneurs. Usually for, if you are on an entrepreneurial route, maybe 1099, self-employed, something to that effect. If you want to take that route, you can definitely do that. We've discussed a little bit about it. Investing passively with a syndication or a fund. So that's all the guys or gals that's out there that's doing what they have to do, finding deals, managing it, getting the loan from start to finish, closing out on it, managing contractors, the whole nine from start to finish. This is how to limit your risk investing passively, and we'll talk about the benefits of what passive investing is and how you limit your risk by relying on other experienced personnel. What is syndication or real estate fund? We talked about a little bit about that. We'll dive deeper. Investing with cash value life insurance policies. People don't really know you can do that, but you can. So passive investing can change your life.
I'm sorry, I'm going to have to interrupt for 1 second.
Okay, sure.
We're not live.
Are we not live?
I'm sorry.
Yep.
Where's the...
Go back to... Sorry about that, guys. There we go. Live stream. It was live. Oh, it stopped?
For some reason it's telling me this. When I click your link on Instagram.
Okay.
So that's why I got confused.
Okay.
Let me...
Okay. Want to copy?
Yeah,
Copy it.
sorry, email me that again.
Mm-hmm.
Make sure.
Yep.
Sorry
About that, y'all. Let me send this to him. Info at Total Social MG, right?
Yep.
Subject line is going to be live link. Okay. All right, let me know.
Yeah, you're good.
Good?
Keep going because it's being recorded anyway. So.
Okay. All right, no problem. So we will jump back into it. Sorry about that, everybody. So we was at active investing versus passive investing. New investors begin their journey. They deal with the day-to-day operations that consist of tenants, toilets, and trash. Everybody know what that is. So if you invest in on your own, that's what you're gonna most likely deal with, depending on the asset class, of course. But if you're in commercial real estate or even residential, I'm gonna define that. Residential is anything up to 4 units, and then commercial is 5 units plus for multifamily. And you're usually gonna deal with this because usually when you start off, people start off with the first-time home buyer program. They do the daily day operations, and it's not enough just yet to hire that property management company. Now, this is, as an active real estate investor, you will have to find good deals, whether it's through marketing, brokers, realtor relationships, and making offers directly to sellers. Now, people always ask me too, how do you find direct to sellers or even know what to offer? So that's where relying on the expertise, mentor, partner that's been in the game for a while, or even anyone that's gonna go out there and market. And market could mean you actually picking up the phone, calling sellers. Maybe you got a list from www.propstream.com, and that's actually how you find and target, certain properties that you want to do. And then from there, you can call, you can send out mailers, you can send out texts, you can do ringless voicemails if that's what you want to do to find deals. Now, the last one is real estate investing consists of not only finding the deal, but you have to know how to analyze it and which deal is a good deal for you to invest in. Because not every deal is a good deal. Just because it's a deal does not make it a good one. You see here, active investing versus passive investing. When you invest passively, you do not have to handle any daily operations. Not at all. Usually depending on how you structure it, or if you are in a syndication or fund, you don't have to worry about anything. If you're in a joint venture, you have to negotiate or iron out what every party is going to do, which is called an operating agreement. Everyone is responsible for each and everything that they have to do, and then you have to hold yourself accountable. But you can partner up with investors that have experience, and you can bring the capital. So, and that's called joint venturing or investing passively, essentially. You can scale a lot faster investing passively because with the property you sell, you can grow with active investors since they know how to find the deals. When you're finding the deal in real estate, that is the key. It does not matter if you have capital or if you don't have capital. If you know how to find deals, you will scale if you want to. So the benefits of passive investing, you see they at the beach. I love to be at the beach too. It's hassle-free. Get passive income, and you can let your money compound. So compounding effect is just because you put your money in, let's say you put in $100,000, does not mean you will get $100,000 back in 3 months. It does not happen like that. You have to let your money compound, let it grow, let it stack up, and let it roll forward. Private money lending is a return of a different form of passive investing. You can let your money out for a specific interest rate. More time with your family and friends, right? We all love to have more time with our family and friends and go out and travel and do what you have to do. You can retire earlier than you expected and buy your time back. People don't believe that you can buy your time back, but you do that by investing in something. Even if it's not real estate, if you don't understand it, but maybe it's something you do understand, such as a business component, or you partnering up with somebody and starting a business, you can buy your time back by increasing your cash flow. How to invest in real estate with your self-directed IRA. All right, so I like to do not necessarily a Q&A all the time when I'm speaking, but everybody know what a self-directed IRA is, right? Okay. So if you don't know, YouTube as well, the traditional IRA, often called a rollover IRA, can be used for anyone who earns or those filing jointly with a spouse taxable compensation until they're 72 years old, right? So the traditional IRA, which is called IRA, is widely known for its tax advantages as the accountant as the account owner does not pay taxes up front, and the contributions can be tax deductible. So, if you do not know what that means, it is something called tax custodians or IRA custodians. I won't say tax custodians, but IRA custodians that actually can explain in further details to you. Or if you have an accountant, a CPA, a financial advisor, they can actually explain more in terms and in depth with you so you can make sure you understand before you invest. All growth within the account is tax deferred, but you pay most taxes upon distribution. So hence the name, you don't pay no tax up front, but when you take distributions, you pay some taxes. You can take distributions at any time. However, a 10% penalty is applied if you take a distribution before 59 and a half. After 59 and a half, distributions are penalty free, but taxed as current income, right? Once again, consult your financial advisor so they can explain what that means. So how to invest in real estate with your solo 401k. So a lot of people did not realize they have a 401k when they start a job, right? And you either can opt in or you can opt out not to do it. It's up to you if you opt in or opt out. But if you opt in, make sure you understand what the actual 401k is. Not every 401k is a solo 401k. You have different forms of IRAs, IRA, or you have different forms of 401ks. A solo 401k is a retirement account for self-employed individuals or business owners with no full-time employees, right? This account has quite a few advantages other accounts don't offer, but also has many things to be aware of to make sure it's being administered correctly. So once again, custodians can walk you through everything. Your financial advisor can let you know the pros and the cons of each and every one and to make sure you fully understand. So a solo 401k allows for participant loans. You can borrow up to 50% of the account balance from a solo 401k, but just not more than 50,000. So certain things you could do and you cannot do, but you have to have a minimum of 1,000. You could take multiple loans subject to the multiple loans rules. So once again, make sure, I'm not trying to go fast, but make sure that you speak with someone about what that is. So investing passively with the syndication or fund, right? So everybody that's here know what a syndication of fund is. Okay. So YouTube, if you do not know what a syndication of fund is, we will get into it, but just bear with me. I want to explain investing passively with a fund can help you, or syndication. If you want to invest with a syndicator, hence syndication, so you have a syndicator, or fund manager, hence the name fund, you have the option to review the offering documents beforehand, which is a plus to make sure you know what you're getting into and you know who actually operates the fund, and you know it's filed with the SEC, which is called the Security Exchange Commission. You can choose which fund or sponsor you want to invest in. You can get a fixed return on your money, and the percentage is different for every offering that you see. Not every offering is the same. You may see some syndicators offering, 4% all the way up to 10% with a slight return or some equity, which you have two sides. You have a private equity fund or you have a debt fund. And then we'll talk a little bit about the advantages and disadvantages of both, further on. The fund manager does all the work, or syndicator, from finding the deal, analyzing it, obtaining the loan, doing all the due diligence, and the closing. So essentially, you don't have to do anything. Once your investment is with the fund manager, you can sit back and enjoy the income. So once again, review the offering, make sure you understand when is the actual investment being distributed out, which some people do it semi-annually, some people do it annually, depending on if it's a land development. It may take a little bit longer to actually pay out, or they do it quarterly. So it just depends on what the the fund manager has with his offering documents. So can you limit your risk investing passively? See how sitting in the coffee early in the morning, she's not worrying about nothing. So she's not worrying about anything except for enjoying her life, right? So how can you limit your risk? Every investment comes with risk, but you minimize it by investing in a hard, tangible asset such as real estate. You have stocks, you have crypto, You have all of these different things that you can invest in, but real estate is tied in true because it's always going to be here. No matter if we long and gone, it was here before we got here. It's always going to be around. When the capital is deployed, you have appreciation over time from the property and depreciation over many years to reduce tax costs to the IRS. Now, how can that be beneficial towards you if you invest in passively? How? So if you invest in something, if it's a private equity fund, you invest in something, your actual equity grows over time. You have what's called depreciation for residential and commercial. They give you so many years you can depreciate it, and you can depreciate it at a fast, accelerated pace, right? So reduce your taxes when it's actually time to file taxes. During great recessions, real estate was one of the top industries to recover and a great hedge against inflation. So everyone knows that we're going through some type of inflation right now. So to meet and beat inflation, real estate is one of the top industries and has and always will have and created the most millionaires in the economy. So just through investing in real estate. All right, so what is a real estate syndication or fund? So as we stated, you have, and I'm going to talk a little bit further about it, but let me just speak about the slides first. A syndication is when an investor or a group of investors pull money together from accredited or non-accredited individuals that have an interest in investing money into one particular project. So before I speak too fast, everybody knows what an accredited and a non-accredited investor is, right? Yeah. Okay. So if you don't know, YouTube, an accredited investor is anyone that brings in an income of $200,000 or more for the past 2 years, and they expect to do the same for the fourth and every so often for the forthcoming years. And a non-accredited investor is exactly the opposite. You just work a regular job, doesn't matter. You do not make 200,000, maybe not just yet. And also, too, an accredited investor, you have a net worth of $1 million, excluding your personal primary residence, or have a joint income of $300,000 with their spouse. So that's what those two differences is. I don't want to confuse anyone. A real estate fund is when a fund manager pulls their money together from accredited or non-accredited individuals that have an interest in investing money into the fund. The fund can deploy the capital into several projects instead of one project at a time. So the biggest thing between a syndication, which is you put money into a syndication, they use, let's say, apartment building. You buy an apartment building. You put money with the syndicator. The syndicator buys that one apartment building, and that's it. They usually fix it up, decrease expenses, sell it, do different things to make it more profitable. Now, a fund, when you have a fund, you can invest into the fund. The fund actually owns multiple properties into the fund. So that's the biggest thing. A syndication is usually geared towards one project or property, and a fund is geared towards many properties that it can be controlled into the fund. A passive investor can choose which strategy works best for them, right? So I'm going to recap it. You have a private equity fund or private equity syndication, and then you have a debt fund, right? So private equity, hence the name, you getting a return on your money, and you get some type of upside. Upside meaning some type of a value add component that the syndicator is doing, right? And you get some equity with that. A debt fund, you get a fixed return. But that debt is owed back to you on top of your principal. So it's a fixed return, right? And it's good and bad as both of them. I won't say good and bad. I'll say pros and cons, right? So the con, I'll say for private equity, if you ask me, for private equity, is usually geared towards that one project, right? If something goes wrong with that project, that's it. With a debt fund, you get no upside as far as the equity, but you get a fixed return. You can guarantee on that return, and you get multiple projects into the fund. So if the fund has 10 properties, one is not performing so great, you have 9 others that can still pay you. So that's the biggest difference, and it's very powerful. So a passive investor can choose which strategy works best for them. I recommend looking at different offerings to understand which one works best for you. And you meet all the guidelines from the Security Exchange Commission. right? So hence the name, short term, everyone calls it SEC, which is an entity that regulates and oversees security exchanges and to make sure it's fair dealing and to prevent fraudulent activities from happening. So that's the beautiful thing about either owning a fund or having a syndication, because then from there, you understand that this person is filed with the SEC. You can look them up. You know, you can actually vet them out. You can see their documents. You can make sure that they actually are doing what they say they are doing, and they are who they say they are. So that's the powerful thing about that. Let me see here. So investing with cash value life insurance policies. So everybody know that's here, know that you can invest with that, right? Yeah. Okay. And if you on YouTube, if you don't know that you can invest with cash value life insurance policies, well, I'm letting you know now that you can, and this is how you do it. You have permanent life insurance, which is called whole life, which is life insurance policies that offer lifetime protection, right? And we're going to talk about the difference between the other one. Your premium payment will never increase, and your death benefit is guaranteed to last forever. So once again, make sure you speak with your estate planning and financial advisors and everything else to make sure that you structure properly. Because sometimes I see people structure with cash value life insurance policies, but it's not a whole life, it's a term life. So what people don't understand is a term life is, hence the name, is set for a particular term. So if you have life insurance for, 5 years, after the 5 years, you have no more life insurance. So you have to make sure you understand the differences. Term life is the opposite, right? Which we just talked about, of whole life. And once the term of the policy expires, you have no insurance. It goes away. So you want to make sure you keep that and make sure that you understand which way that's best for you, that you can invest. How can you invest? You can use your cash life value to either lend the money to an investor at a higher interest rate that you have to pay, right? Because you got to pay it back, or invest into a fund, or if you're an active investor, you can deploy the capital into your own deals, right? So hence the name, you can borrow from your life insurance at a particular interest rate. You could take the funds, deploy it somewhere else, and get a better return in real estate. And then now you're not paying yourself back out of your own pocket. You're paying yourself back out of your investment. So that's how that works. And then I recommend you speak with your insurance specialist to determine which route may best suit you. So I always have to disclose that because everyone has their own legal advice, counsel, financial advisor, planner, whatever the case may be. And then they can definitely help you out when it comes to that. Let's see here. Okay. Passive investing can change your life because I know it changed mine. But I would say I was more on the active side. But passively, it can change everyone's life, right? You got more time to travel, and you have debt consolidation by paying off your bills. Because think about it, it's not coming out your pocket. You deployed your capital into a particular project or to a fund, and then now the money comes back to you. So if you have debt, you can pay off some debt, keep the rest for yourself, and let it continue to grow and compound. Then you have financial freedom, right? The way I always tell people too, if you have a freedom number, write it down, right? Maybe it's 5,000 a month, maybe it's 10. Some people want 100,000 a month, and that's totally fine. You know, the sky's the limit. $1 million a month, that's totally fine. But let's start off small. Let's be realistic. If you know your bills is, let's say 5,000 a month. Hey, 6,000, 7,000, 7,500, 10,000, that'll set you free, and you'll be officially declared financial freedom. So no more stressing about money. Money is I don't believe the term money is the root of all evil. I don't believe that. I believe that if you know how to control your money, you are smart with it, you got a good team that can actually show you how to grow it, then you will be financially free and you can help others do the same. The income from your investment can go towards your kids' college education. So I think that's pretty exciting for a lot of people, especially on YouTube, right? If you have kids and they have college that they are attending, keep in mind you can use this passive investing method to actually grow your kids' college as a education or tuition. So let me see here. Any questions for everybody that's here about anything on here so far? A fund, difference between the fund, syndication, all good? Okay. YouTube, I can't hear you, but if you got questions, put it in the comments. Okay, let me see here. All right, so we're going to talk a little bit more about how I can help a lot of people with their goals and how we can help you achieve everything that you want to achieve, right? Just give me 1 second. Let me see here. Okay. All right, so. Okay, so what is a global investment capital group? So, global investment capital group is a debt fund. Why did I choose debt fund? I explained the difference, if you guys remember earlier, about private equity versus a debt fund. I chose a debt fund because there's more safety involved into it, right? When you have a private equity fund, I'm not saying everyone is good and the other one is bad, not saying that at all. This is what I just chose to be the most powerful method for a lot of investors that want to come in. You can cross collateralize against the asset, all of the assets in the fund. So if it's 30 properties in the fund, your money is cross collateralized against all the 30 properties. And you get a fixed return. And that's semi-annually. But we'll talk a little bit more about that. But that's what Global Investment Capital Group is. Essentially, it's a private real estate investment fund, right? So then we're going to talk about the people. We're going to talk about the projects, the property, and the product of what I like to focus on. The positioning, right? The uniqueness to what I do and to how you can do the same. Just replicate the same thing that I'm doing, or even better, right? If you like another asset type. The performance, how is it performing right now during the economic, I won't say economic downturn, but I would say in an unusual climate that we're in right now, right? With inflation and goods going up and things of that nature. Now the profit, how's the profit being paid out? How am I making a profit, right? So Global Investment Capital Group offering, the overview and details, and how you could get started, right? So, all right, the history. And let me see something really quickly before I talk about the history. Okay. So the history, Global Investment Capital Group, I like to call it GICG Fund, right? It's a short little acronym for it. And Anthony Lawson, a select group of experienced team associates, started the fund in 2020, which was this year. I was doing a lot of joint venturing, and I grew my portfolio substantially, and I wanted to do a fund to help more people get into it that don't know what to do with their capital. So 2022 to assist accredited investors in both U.S. and foreign areas to get into larger and safer real estate projects and opportunities. Global Investment Capital Group is a debt fund, which I explained a little bit earlier. And I like to stick to what I know, which is being secure, high cash flow, very liquid, no hassle, and low to no liability way to invest. Keep in mind, full disclosure at the bottom, SEC defines credit investors as a net worth of $1 million, excluding your personal residence, or $200,000 a year income, last 2 years, expect to do the same, or $300,000 a year with your couple or your spouse. All right, so that's me right there when I did another event, right? Nice little tie. And the people is myself. The fund is led and operated by Anthony Lawson, which is me, who is an experienced real estate investor with a professional team of experts, along with experienced fund managers and joint venture partners. So what does that mean? I do deals with a lot of other fund managers. So if the fund has liquidity coming in, and if they had a very good project coming in, I can do a joint venture with them and to grow the fund exponentially with another fund. A global investment capital group fund projects or compromise of a team of knowledgeable and qualified specialists, such as developers on my team, architects, designers, subcontractors, because full disclosure, I am a contractor, and I have my partner, Kyle, that's a contractor as well. We are licensed and insured in New Jersey and in Ohio. And we do projects. We have project managers to oversee some of that stuff so we can grow, and several key personnel. So fund manager, myself, it's another fund manager I deal with named Sharif. That's him teaching his philosophy, how people can grow as well too, his fund. and how both funds can come together and do phenomenal things. All right, so the product, let's talk about that. What does that mean? The product/properties. So YouTube, distressed properties in unique development projects in the states of New Jersey, the Midwest regions, and the opportunity to expand in other markets. The other markets I'm focusing on is Georgia, Texas, and Florida. Why is that? Because very good returns there. The actual population is growing and the trend is going up. So I always like to look at trends in different markets and to see what's going on there and see how we can make it grow. So deals are acquired often directly from banks, where I have relationships where I can get deals off market with, it's called REOs, right? Real estate owned properties from banks. And I get it from private sellers. Defaulted developers, what does that mean? Defaulted developer is someone that was developing a project that it fell through, right? Maybe it was from liquidity, maybe it was a short timing in the market, maybe it couldn't happen because lack of the team, you know, we just don't know. But defaulted developers and or through brokers who have off-market deals that need cash offers and fast closings, right? So if the fund is highly liquid, then we can always offer all cash and do a refinance to continue to pay investors. The goal is to acquire residential. I like to acquire residential and flip those in commercial properties in great neighborhoods, below market prices, because keep in mind everything I'm telling you guys, YouTube, get it below market. If you get it below market, you will never lose, all right? And make sure that you develop them, reposition them wisely for maximum cash flow and or resell profits within a relatively short period of time, right? And I make sure I do that because keep in mind I have to pay my investors. So if residential, we like to acquire those below market. We flip those to keep the liquidity coming in. And then with commercial, we like to hold commercial, usually buy them all cash, refinance them, and pull out some profits. And by the way, too, here and YouTube, when you do a refinance, it's tax-free. So I want to make sure I throw that in there. Right, so the positioning. GICG fund has a durable competitive advantage. Why is that? I have a system in place. I have an experienced team of insiders and well-connected and well-capitalized, right? If we capitalize, you can close on deals faster with all cash, you get the deal first. He or she that has the deal and has capital and that can close, you will get a lot of deals thrown towards you from your connections. I have a good business model, which we will talk about that. That has been valuable for years to those with cash, experience, and qualified team. The fund is able to work joint venture partnerships. Remember, I talked about what a joint venture is, right? Partnership with other funds such as Mixif. Mixif is owned by Sharif Medawar. It's another good friend of mine and / another mentor. His is called Medawar International Group Secure Income Fund, right? And SFI fund. He had two funds. So I have two funds that I can do joint ventures with. I can deploy up to 100 million in the market with good margin of safety, liquidity, and little to no liability. Why? Because I told you guys, if you can close on something all cash and you can make it happen, it's a margin of safety right there because you can always do a refinance. All right, so look at the targeted properties right here. This is in the Midwest. I was trying to put a lot more here, but it was giving me a difficult time. But this is in the Midwest. This is a 16-bed facility, right? This is a 115-bed facility. This right here to the right is a commercial building in the shapes. It shapes as, I don't know if YouTube can see it, but it shapes as in like a U-shaped form, right? U-shaped form, and we bought the property next door, it was difficult to get that on here because of the angle. We bought the property next door, and to the back, if you look right behind the trees, it's called an ADU. The ADU is an additional dwelling unit, right? We was able to fit the previous seller 20 beds in there. So this is a sober living facility right here, right? So can fit 80, this can fit 15, and then you got another 20. So it's around 115, right? And we're still doing some renovations there. The front doesn't even look like this. We all new windows throughout the whole property. And from there, we were able to make it grow and do refinance. We was able to close all cash. Remember what I told you guys, all cash. And then we're going to fix it up all cash and then re-pull our money out when the value jumps through the roof. And then here was already stabilized, right? It's a 16-bed facility. This is a group home, right, in Ohio. And then the group home, we do some quick math, right? I like math, so I like numbers. So let's do this, right? If you on YouTube, type in 1100 times 16, right? 17,600. That's what comes in gross every month. After expenses, how do I know this off the back of my head? Because I like numbers and I want to make sure that the projects and art is performing as we stated. So this was just, these two properties are not in the fund. These are just joint venture deals I did with a partner. All right, we had to close all cash on both deals. So 17.6 comes in. After all expenses, I have 2 staff there. We're hiring 3. And but when it was 3 staffs, we had, that's about 5,000, I say, a month in payroll. We have food. We pay everything. The residents don't pay anything from utilities, in the whole 9. It comes out to net around $7,800 a month, close to 8,000. Sometimes it's a little bit higher than that. Depends on things that we had to pay for. And we're actively renovating the building as well. And by the way, why do I target certain properties like this? Number 1, I'm helping the community, right? Number 2 is low competition, right? I have very limited competition. Everyone wants apartment buildings, which is nothing wrong with that. But in the same token, why do everything someone else is doing in the red ocean when you could jump to the blue ocean and have limited competition? So that's another reason. And then from there, right, this particular deal, we bought it at a very good deal, right? And what do I mean by that? The seller was motivated to sell. After they got out the deal, we got it at a very good price. And we came into the business, we got it the business and the real estate. We was able to acquire it for $325, very cheap. And by the time we sell it, reposition it, fill up that last bed, we still putting laminate through the whole thing. And because this thing was very outdated, from carpet everywhere. I do not like carpet. So no carpet, YouTube. Put laminate floors. So we doing the whole building, and then it'd be worth around 1.1, somewhere around there. Maybe, I think it should be worth closer towards $1 million. I want to be conservative, closer towards $1 million when you sell the real estate and the business together. So that's a good deal. And then this one right here, we got it for very inexpensive as well, closed all cash, to bring a nice profit every month. And then that one will probably be worth around $600,000. And we got it for a very inexpensive price. So the performance / process, how does that work? We like to stick to the fact system. What is the fact system? F is to find, right? Most opportunistic projects is based on the location, the price, the condition, and the potential, right? What does that mean? If it's in a bad area, it may be tougher to sell, which hence the price, because you're going to have to lower it because it's in a bad area. What's the condition? Maybe it's nice, but can I do something to return it around and make it into another, high value potential? So the location is key. In real estate, we always say location, location, location. So the A is for analyze, right? What is the current market? What is the expected trend? Remember how I told everyone I'm going into Georgia, Texas, and Florida for a reason. The trend is going up, right? Yes, things happen in Florida. You get hurricanes and things of that nature, but it's the #1 state to retire. So, and then also, by the way, I didn't even mention I'm going into New Orleans, Louisiana. Why? Because they have a historic area. There's very low competition. And I plan on doing some good things there. And I'm able to control the process, right? How do I control it? I negotiate the best deal or the best price, and I get creative with terms. What does that mean? I can buy a property at $1 million at a 8% interest rate. I can sell it at $1 million at a 10% interest rate. And I think someone in the audience, we talked about that too. And how am I still able to make money? Because the interest rate is higher. So I'm still able to make a profit even though I sold at the same price. So a lot of people, you just have to get creative on terms and how you can make things happen. All right, YouTube, you got that? And you time it. What's the due diligence, right? You got to time the process. You got to make sure that you can acquire it, get flexible terms with the seller to make sure that you can close out and fulfill your obligation on the contract, right? You got a due diligence period. Usually with commercial, it's called due diligence. Residential is called inspection period. With commercial, you usually get about 30 to 60 days, if not longer. Residential, sometimes you get about 7 to 14 days. Sometimes 21 days, depending on what state that you're in. All right, so you got to acquire it, which is acquisition. You got to rehab it if it needs rehab. Maybe it doesn't need rehab, but can you reposition it to make the value higher, right? Which goes into this, repositioning and renting or selling, right? Keep in mind, I'm telling you guys my formula for money, making money. I buy residential and flip residential. I do not like to fix and flip single families. I like to fix and flip 2 to 4 units in New Jersey. Why? It's a hot market. It's a scarcity of inventory. So with a 2 to 4 unit, I can sell very easy. I do not have to put it on the market. I can call a couple realtors and brokers I know, and they can sell it within 5 minutes, literally. So it's easy to sell those. And then I rent or sell them. In commercial, I can get so creative, I add so much value to it, it's worth 3 to 4 times more. So that's how it's so much liquidity that comes into the fund, and it's safe because we're still able to pay out the investors, right? And then the S is for strategize, right? So what does strategize mean? You have to have strategic partnerships, right? And I know a question you get is, okay, if you're doing a JV deal with another fund, how can you make sure things go good, right? So you strategize the partnerships by making sure that the person is in the real estate industry for a while, right? They have their own team. They've been doing it. They're filed with the SEC if it's a fund or a syndication. And then make sure that they have a good team around them and make sure that everything is good with the project. So that's how you control the partnerships. The rehab and resale residential. I told you guys my formula. Refinance, manage, and hold commercial. I won't just say refinance and keep commercial. You got to manage it too. You always got to manage the manager. If you have an apartment building, you have a property manager. You got to manage the property manager and make sure everything is good. So let me see from here. All right. Okay, the profit/returns. Global Investment Capital Group Fund. Here's the beauty of it. A lot of funds, you got to invest at least $100,000. With us, you can invest $25,000 per share. Just 25. Just a little sneak peek, you know, if you want to see what the fund is about. And then you can invest many millions as you want. You know, it's totally up to you. So all capital is cross-collateralized against all the real estate in the fund, right? That's the beauty of it. You do one deal, maybe it's a land development, I'm going to say. Maybe you'll have 10 apartment buildings in your debt fund, and you have land development you want to build an apartment building on, but it's going to take 2 years to build. You have 9 other properties in the fund that can still pay out while you sit there and build the land development. So you see how powerful that is, YouTube? Okay, you have payouts are semi-annual, twice a year, February 28th and August 31st, right? That means the fund is very liquid. We keep the money coming in when we flip and everything. And then when the fund comes in, we pay out twice a year. It's very safe for people. They get a fixed return. They forget about it. They get the money in their bank account or they get it mailed to them and they are very happy. And then you have the shares, right? You have 3 classes of shares, which I didn't put the last one because it's mainly towards institutional investors or institutional places like life insurance, places that want to invest, things of that nature. But we're going to talk about the first 2. First 2 is the A share, which is 8% minimum. It's $250,000, which is 10 shares, because keep in mind, 1 share is $25,000. So you get an 8% return at 250 plus. And then the B shares is 6%, minimum 25,000, right? So 25,000 will buy you in at 6% interest rate. And then 250 plus, that's 8% interest rate. The fund is filed with Security Exchange Commission. As I stated, we fully filed. And it's all the way good until December 31st, 2033. And we may extend. Most likely I will extend, but just wanted to throw that in there. Which is a government entity that controls and regulates private funds. So every fund, syndication, everything is fully filed with the SEC. You can look it up. and then you can take it from there. Here's the beauty of it. My fund has no acquisition fees. So what is the acquisition fee? Everybody here know what the acquisition fee is? Okay, YouTube, just put it in the comments and we will respond. But the acquisition fee is, I'm using a private equity fund, right? Private equity fund, they usually do I won't even say 2. I seen some like 1 to 3%, right, fee. So if you do, let's take out the calculators, right? If the fund is raising, or the syndication that, is private equity, $1 million, right? And they have a 3% acquisition fee, what's that? $30,000. So that means at closing, that private equity syndicate is going to get $30,000 for finding the deal. They negotiated it, things of that forth. I don't do that. Why? I mean, personally, I like to say that when the money comes into the fund, I'd rather see that you perform, you get paid, I get paid. Simple way to do it. I stick to what I say, then you get paid. No management fees. A lot of private equity funds have management fees, right? They're managing the manager. They have to stay on top of things. They got to check in. They got to fly there to make sure it's going good. Me, I don't do any management fees. I have my team set up already in different states. So then now they go in, they do their thing, and I'm not charging anyone to manage it. No withdrawal fees, right? Some funds, if you want your money out, you got to pay a penalty. I've seen some interesting private placement memorandums, which this is what this is called right here. It's pretty interesting that we discussed it. And I have no fees, period, right? And here's the beauty of it. Let me see if it's on the next slide. So we'll talk a little bit more about the offering. But you could cash out in 12 months. I don't know if you guys are used to that or have actually heard that in other private equity or debt funds. It's very difficult to cash people out in 12 months. How are we able to do it? We keep good liquidity in a fund, right? When you keep good liquidity, you can cash people out. Just give me a 12 months notice. We will send you your money. All right, so here's an overview of it. Global Investment Capital Group. It's a New Jersey limited liability company, LLC, with company offices in New Jersey and Cleveland, Ohio. Have offices there and working on a few offices in 2 places. I don't want to say it yet. I want to wait till it goes through. Global Investment Capital Group is a debt offering, as I stated in the beginning, so investors can enjoy the advantages and the right of lenders, right? Including security. You got promissory notes against all the properties. So that's how it's secure. You got those notes that's cross-collateralized, right? You get your money back. You got generous cash flow, interest income paid semi-annually, which is twice a year. Remember, February 28th and August 31st, right? It's twice a year. Then you got high liquidity. As I stated before I started the slide, give me a 12 months notice for withdrawal, Class A and B shares. I will not discuss C because that's a little bit different for institutional investors. But regular investors, you give me a 12 months notice, you get cashed out, right? Hassle-free. You do no day-to-day decisions. You don't have to worry about anything. You can call anytime. If you want to go see a project, have no problem with that. If you want to go see how the apartment building looks, feel free. If you want to learn, it's up to you, but it's hassle-free. No upfront fees, no management fees, no disposition fees. So what is disposition? YouTube. Disposition is when you sell a property, you get a fee for selling it, right? The upside, the added value. I don't charge anything for that. So in that same example, let's say it was a 50-50 split in the private equity fund, right? Between the syndicator and the investors that came in. When you sell it, if the upside was $500,000, $250,000 will go to who? The syndicator. And then the other $250,000 will go to who? The investors. And then you split it up depending on how much they invested and things of that nature. I don't charge any of those fees, so you don't have to worry about that. So the offering is structured to enable credit investors to benefit in 3 ways. What is that? Direct cash investment. You got cash from savings. You got 401ks that we spoke about, solo 401ks. You have lines of credit, right? That's low interest. You have many different things that will allow you to invest if you're a credit investor. You have qualified retirement plan investments, right? Self-directed IRAs. We spoke about that in the beginning. You have pension funds that I didn't even touch on because I know I don't know about the whole country. I got to look into it, but I know for New Jersey, a lot of places are going away from pension funds and they're going to 401ks. So it's a little interesting. Then we can arrange 1031 exchanges into the fund and defer your capital gains, which is very interesting. And we can talk about that if someone is selling, maybe they're an credit investor, they're going to make 500,000, but they don't want to pay any capital gains. I can show you and teach you how to defer those taxes, right? By investing into the fund. Right? Invest in safety, lower risk, income, and liquidity. Right? So that's the end of Global Investment Capital Group. Right? So any questions so far about anything? Questions? Everything was just, it's kind of a lot to absorb, right?
It's good.
It was straight and clear to the point?
Yeah, it was clear.
Okay.
If you have any kind of, you've been dealing with, even,
Yeah.
The stock market or something,
Yep.
you'd probably know
Yep.
what most of it.
Absolutely.
Yeah.
Yeah, because the terms are interchangeable, just a slightly different for real
Yeah,
estate, but
you,
a little bit different.
You gotta explain to people what the insurance.
Absolutely.
The cash value, because
Yep.
many people don't really understand that.
No, they
Even
don't.
in-
They don't.
Even in the profession itself, like
Yep.
they're like, what's cash value?
Yep.
I could borrow something against that. Oh,
Yeah.
I didn't
Yep.
know about that.
Yep.
They're overfunded, for
Yep.
no reason.
Absolutely. And then I know the laws changed too. So the reason why I tell a little bit about it, because I don't go in that profession, right? So I always tell people consult with your financial
Yeah.
advice,
So
because they,
complicated thing,
yeah, and they stay. That's their profession. They stay into it. They stay on top of the laws. I make sure I'm on top of the laws, but that's their profession. So people have their own estate advisor, financial planner, things of that nature. So it's best to consult them. But yes, I agree with you. Cash value and life insurance, people don't realize that you can borrow from your life insurance to invest somewhere else. The interest rate that you get here is going to be one thing, but you're investing at a higher interest rate and you collecting the difference.
And the reality is like you just pay like 1% over
Yep.
whatever how much you borrow. Like
Absolutely.
it's like it's the cheapest way of
Yep.
borrowing from yourself.
Yeah, absolutely.
Why do you pay the bank like 7% for no
Yep.
reason?
Yep, absolutely. Yeah, I agree with you. In the bank, the interesting thing too, they would charge you something, but it's like, if you know how to make a higher interest rate somewhere else, you will always win. Because everyone's saying now, but what about interest rates? The rates are going up. Doesn't matter. If you know the bank are charging right now, I think it's at like 7%. 7%. If you invest in somewhere and get 8%, or 10%, 9%, doesn't matter. Even if, and I tell people too, it's interesting. Where's your money at right now? Oh, I have $250,000 in the bank. Okay, how much are you making at the bank? 0.0001%. Even if you invest in and you said, you know what, I just want to test it out at 25,000, you're still getting 6%. So that's better than what you was making at the bank.
And diversification, you never touched
Yep.
on that. And
Yep.
the good thing about this fund is
Yep.
you don't put everything into the markets.
Correct.
Markets are securities.
Yep.
They're pieces of paper.
Yep.
They can, overnight they can be worth nothing.
Yep.
As you can see, crypto.
Right.
What was that? Tron. That went from $60
Yep.
a unit to
Yep.
0.
Yeah, you're right. You're right.
Overnight.
Yeah, you're right. You're right.
Property, okay, it's gonna fall.
Yep.
But you still get rent.
Yep.
You still have a cash flow going on.
Yep.
You don't have to sell. If you
Correct.
want to sell, you don't have to sell. You can
Absolutely.
refinance it. You can help a buyer buy it,
Yeah.
and you can lend money.
Absolutely. And the beautiful thing too, that's a good point. The beautiful thing of something like that is, even if, let's think negative, right? Everyone says, what is the market is going to do? Doesn't matter. I tell people, it don't matter what the market is doing. You just adjust to what the market is doing. If the market is tanking, is bad, is sucking wind, it doesn't really matter, because guess what? You buy a commercial,
True.
you add value,
Yeah.
the value of the commercial goes up.
It mostly depends on the rent. If
Correct.
you can actually raise the
Yep.
rents, you
Yep.
can increase the value of the property overnight.
Absolutely.
If you can get if you have people in the townhouse.
Yep.
What is that? Town hall? Or,
Yeah, town, City Hall.
Yeah,
Yep.
City Hall. They actually can, if you have good contacts with
Yep.
the mayor and stuff, you can double your
Yep.
investment in like a month.
Yeah,
Right?
absolutely.
If you actually get all the permits and shit.
Yep. Yeah, absolutely. I mean, I agree. It's something that I think people have to really understand how to actually invest.
True.
Right? So that's why we're here to make sure we, talk about different things, because if you just rely on what everyone is saying out there, it's going to be tough to make it, because it's designed, and I'm on camera, right? It's designed for negative output,
True.
right? That's why you don't see anything positive so much on the news, right? You're not going to go up there and see, oh, such and such just had a baby, and the baby came out, they're having a good life. You're not gonna see that. You're gonna see, such and such just fell and she was pregnant. Man, it's so negative.
Everything is negative.
Everything is negative. So if you listening to that, your brain, your brain fragments is just gonna absorb. Okay, is 8% interest rate out there? I'm so scared. I don't know what to do with my money.
And I want to point out that you have 7 years of experience in this
Yep.
field. If you're starting off, and even if you have money,
Yep.
you just can't just jump into at least the property market. Okay,
Correct.
I can say stock market.
Yep.
You can be lucky. It'll
Yep.
be like first guess, something happens good. Oh, okay,
Yep.
I made like 20%
Yep.
in 5 minutes.
Yep.
But real estate is such such an asset class that
Yep.
you got to have experience.
Yep.
You got to have the negotiation skills
Yep.
with the seller.
Yep.
You need to ask the right question.
Correct.
Because you can buy a palace made
Yep.
of what is that, lead or
Yep.
whatever paint and shit.
Yeah. Yeah.
It has no value,
Yeah. You're right. You're right.
and you'd be
You're
like screwed. Oh my god! I bought this for $1 million. It's after cleaning up, it's
Yep.
just 350,000.
Yep.
Oh,
Yep.
I lost. I hate real estate.
Yep.
You don't have to hate anything.
Yep.
There's opportunities in everything.
Yeah. You're right.
Just open, your mind
Mhm.
to the possibilities.
Mhm.
As a realtor myself,
Yep.
I have seen people become like, in 10-year lifespan,
Mhm.
even investing into a passive fund like this,
Yep.
become millionaires. Because
Absolutely.
it was good timing.
Yep.
The fund manager took the right decision.
Yep.
And guess what? They're millionaires.
Yeah. Absolutely.
You can see the property trending too. Like
Yes.
in 2010,
Mhm.
some people bought property in Jersey City for 100,000.
Yes.
Now,
Yes.
it's 950
Mhm.
to 1.2, and nobody's selling.
Yep.
Nobody's selling.
Yep. Yep.
And guess what? They break one single family houses
Yep.
into 3 dwelling units. They don't
Yep.
want the commercial thing.
Yep.
And then they make so much shit of money every single year, like
Yep.
charging 1,800 per
Yep.
unit. That's 6,000 in rent
Yeah.
per, and 66, 70,000 a
Yep.
year.
Yep.
And get 10,000 in what do you call that? Property tax.
Yep. Yep.
So still.
Yeah, absolutely, absolutely. And it's interesting because you bring up a good point. For example, even my mentor, right? I'm gonna use him. He started his fund in 2008, going into 9, when the market was at its bottom, and everyone, why would you do real estate? But guess what? His fund is doing phenomenal. And people have been with him for many years. So that's all it's about right there, right? Where you have a good person that's running it, right? And they understand the asset types, and they're going out there doing it. I just think people are too negative, and they absorb it in negativity, so they don't understand. It's like it clouds their judgments,
It's because of, finance has been so rocky in the past 20 years.
Yep.
You have Ponzi schemes, this and that.
Oh yeah.
But
yeah.
we're not going anywhere.
Yep.
Once you're in real estate, like
Yep.
literally, why would you leave?
That's true.
You're still there. You're still there. We have, but
Yep.
realtors like 40 years in the profession. Who's going anywhere?
That's true. That's
And
very true.
Guess what? You have like 5 years no sale. You get back in. You
Yep.
back into the game.
That's very true. In real estate, it's literally everywhere, right? People don't realize. You go to
There's
school.
limited
What
time.
is it? That's commercial real estate. You go to school. That's commercial real estate.
Exactly.
You go into office. That's commercial real estate. So it's something that will always be here, and it always have been here for many, many, many years, way before us. Oh, yeah.
It's gonna be here after we attend. Like.
Oh,
it's,
yeah.
It's gonna continue on its legacy with
Yep.
someone else building shit up.
Yep.
It's gonna be.
I agree, man. I agree. It's interesting to see what it do. As far as, because even when if it do go down, that's a better time for
And
me.
one thing of I point out 25,000 in.
Yep.
It's not big money nowadays.
Oh yeah, no.
Try it out. Try.
Yep.
Try them out. he has 7 years experience in the field.
Yeah.
It's not like, the guy just got out overnight.
Yep.
I just want to be a real estate fund manager,
Yeah, and that's the cool thing too of how we structure, because 25,000, it allows you to test, if you want to.
8%.
I always tell people, you test, you get impressed,
Exactly.
right? You test it out, you're like, oh wow, this is working out. I want to put some more money into it. Then it's up to you, And then it's a 12 months notice. You give me 12 months, we get your mones back.
I haven't seen
no
people
hassle.
like at least 3 years. Most fund managers, at least you need
Yep.
36 months to 24 months. 24 months was
Yep.
minimum. You need
Yep.
to give them a notice. 24 months. I'm going to withdraw money.
Yep.
This is 1 year. Like, come on, 1 year just passed.
Absolutely.
I remember
Yep.
the stuff I did last year.
Yeah, and it's pretty cool, and because I think the first question I got before when I did another presentation was, okay, so I give you 1 year notice. How are you able to cash so many people out? I said, well, if we buying properties all cash and we're doing refinances, the money comes back to the fund. I'm doing flips to keep the money continuously working. So that's how we're able to cash people out. So it's like, oh wow, I never thought of that. So that's how it works. We get competitive in the market. Boom. We buy a property all cash, whether it's a commercial building, especially commercial buildings, because you pull so much money out after you close on it, do some improvements, you increase the value, decrease the expenses. You pull the money out.
One more thing to point out, in real estate, like
Yep.
fixing things costs a lot of money.
Yes, it does.
Experience of yours
Yep.
helps,
Yep.
helps actually lower the cost.
Absolutely. Especially being a contractor, contractor fully filed, could look that up too. And being a contractor, outside of being a fund manager, right? The fund manager, you understand the real estate asset types, the business. A contractor, you understand the building and the numbers are actually how to actually fix things and how much things cost, So it's a good way to actually put both of them together, And when you merge the two, because I think in real estate, that's the most difficult part is contracting.
That's the difference between doing it yourself.
Yes.
And then paying
Yes.
someone to do things, and you're underwater.
Yes.
As soon as
Yes.
you fix something up, oh my God! Now the market value of the property is lower than
Yep.
what I put in.
Yep.
And you're like, oh, why did I get into real estate?
Yep.
You lose interest. But
Absolutely.
if you're doing it with a fund manager, he has the expertise, he has the contractors,
Yep.
he has the realtors,
Yep.
and he's gonna deal with 10 properties rather than you dealing with
Yep.
one property. The real estate guys, like even
Yep.
if we charge like 5%,
Yeah.
we will charge you like 2.5%.
Yep.
Because we need the relationship.
Absolutely. Absolutely. Yeah, and it's pretty cool. We don't, and that's the beauty of it too. We don't charge any fees. I challenge anyone. Go out there, go look at offerings, go ask people, hey, how much do your private equity fund charge? Oh, I charge 2% acquisition fee. How much for disposition fee? 50-50, or 60-40, 70-30. I don't charge anything. You get the investors to come in, have them make money. They're gonna keep referring you people. So that's my business model. I want to make everybody happy. Of course, make a little cushion for myself up top. But other than that, everybody's happy. That's all it's about.
And it's a niche. You're trying to help a community. It's
Yep.
a niche segment. Not
Yep.
many people are in that. Developers are not interested.
Right.
Government's not interested. Nobody's
Correct.
interested.
Yep.
And these people are like, they're living beings.
Absolutely.
Do something good.
Absolutely. And that's the value of real estate too, which I didn't want to talk too much about the institutional portion of it, but the institutional Class C shares is 4%. Why? Because a lot of pension funds and everything, I don't know how, it's amazing how insurance is. Insurance, they need to invest the money. A lot of people don't realize that. The insurance company take all the money. They're the only ones that can charge you a premium and you don't got to pay it back, right? It's interesting. So they usually lend out at like 3%, and then they say, just give me like 4 or 5%. So I'm like, wow, that's interesting. And then they like, okay, yeah, I need to give you 10 million. I just want 4%. Okay. So it's interesting, But that's an institution, right? They have their guidelines of what they need to lend out, a certain
Because
percent
they
back.
actually pay out like 1%.
Yeah, they do. Yeah, it's actually very low. Yep.
Because when it's big money,
Yep.
you can't just buy the whole of New Jersey. It has
Correct.
no value
Yep.
after
Yep.
that.
Yep.
Yeah,
Yep.
if you are the king of, like, if money was a commodity and
Yep.
you were the only one with that,
Yep.
and nobody else is interested, what's
Yep.
the use of it?
Yeah, that's true. That's true. Yeah, you're right about that. I spoke to some. Yeah, you're right. I spoke to some at like 1.5%, 2%. The lowest I seen was 1%. I thought that was interesting. I was like, wow, you guys pay back out 1%,
Because the Fed
but then
just
they keep the other 3. So it's interesting.
The Fed gives you like, you know, if you have like 10 billion or something in overnight fund,
Yep.
gives you a 0.25%, like
Wow.
you know, to the banks.
Yeah.
Lending you at 4%
Yep.
is better than 0.5%.
Absolutely, absolutely. And then for them is big money that they
Yeah.
need to get rid of. Like a lot of people don't understand that too. Institutional places, for them, they have their guidelines. So if you meet it, they just give you the money. You know, there's really no, you know, of course they look into who you are and, you know, all that other stuff. But once you meet that basic guidelines, oh yeah, they give you many millions. You know, it's pretty cool how they work it. You know, and that's pretty much it. You know.
Say bye-bye to YouTube.
Oh, bye-bye YouTube. Bye-bye YouTube. Yep, so that was pretty good timing. That's pretty good.